24th. Just a few days away from Turkey Day, but I would like to say we got 3 good turkeys on the show. But
Question is,
Like,
the question is can
Char-
you get a turkey?
yeah, we got Charles Peabody. We've got wonderful David Maris and Nadine Turman here as your host. Thank you, David is so dedicated. He's coming from his car. I mean, like, how more dedicated can you be? So, David, I figured we should kick it off with you. But
yeah,
you got
well,
your seatbelt on, like you're secure for us. So I feel
yeah,
better.
I guess
You're
I could
strapped
take that
in.
off,
You're
but it feels
strapped in.
safer, just safer of a Starbucks parking lot to be in your seatbelt,
We're
just
gonna
in case.
rename the show Car Talk with Click and
Yeah. Coffee car talk.
Yeah. So I don't have a lot today because we're kind of in a kind of lull post earnings season time. The XLV and the XBI continue to do really well today. The market's up, and the XBI is up like 2.5 times that. I mean, last I checked was 1.5 percentage points, and that's like meaningful outperformance versus the market. So it's been a really good place to be. The XLV is a little trailing a little bit, but large pharma versus the market versus biotech versus the market. They both have had a really good run this last little bit. I continue to think that through the end of the year, that's where you want to be. They are safer places from a valuation standpoint. I did
Except for
see
in
a
your
very
Novo. Except for in Europe and you're in Novo. That doesn't seem like a very safe place to be.
well. Novo has something coming out this. It should be this week. It might be next week that a couple biotech
Okay.
writers have written about that. Novo studied their weight loss drug, the GLP-1s, in Alzheimer's disease.
No, it came
Now,
out. It didn't go well. That's why it's down
oh,
10%.
okay. Sorry. So
Hence my
you're ahead of
note.
me.
Yeah, hence
Oh,
my
okay.
note to you of why it's plunged more than
Uh,
10% to a 4-year low this morning.
okay. So there you go. I was gonna say that there is almost no chance that this is
Okay.
gonna work in Alzheimer's, but if it did, that would be great because it would
Huge,
just
yeah.
be one of those things where weight loss is good for vascular, flow. And okay, so you seem like you have less Alzheimer's. That's not how it really works, but
No.
you might have had a positive cognitive change. But I'm not glad to see that it didn't work. I'm I'm glad only in the way that it kind of wouldn't have been good science had it worked. I wouldn't think that it would
Okay.
work for any mechanistic reason. Um, well, that's actually pretty interesting. So now I have to rethink Novo because
Yeah.
um, Novo's a really cheap stock, and they're going to be a
Okay.
second place runner up for GLP-1s. And so, could you buy it as a value? I like always buying like who said it the other day, and I was like, that's pretty good. Buying winners has always worked better for me than buying like cheap losers.
Yeah.
Now, Novo's not a loser really. They're going to come in second. They have a good balance sheet, and they're they have a great product, but they are the loser in a two-person race. I mean, they are not going to be the winner. Lilly is going to be the winner of this, and Lilly also has a full pipeline of other products. So um, I guess being down 10% is already the verdict. I'm going to think about picking some up here because
Okay.
it's something that they're pretty cheap. And again, I hate picking up losers, but they're not really a loser. They're a high quality drug company with a product that's losing market share. Sounds kind
Yeah.
of like a loser, um, but otherwise very quiet. This pre-Turkey time frame. I'm just sitting tight on the XLV and the XBI, and not doing anything this week.
Or you're just not doing anything. Okay. Yeah. So Nova might be a buy here. So come back. Let us know. Okay, what you think on that. Once you read the note, it'll be in arrows this morning. That's how I knew what was going on here.
Okay.
Yeah, that's right. And Charlie, lots going on in your world. You had a lot to say over the weekend to the folks who pay you for listening to you.
Yeah, I don't know why they paid. I thought your lead-in was going to be since Dave was talking about losers. Speaking of losers, we've got Charlie.
No, never, Charlie. Only
She's
winners
not that
here.
mean. She's not
Yeah,
that mean
I'm only
publicly.
kind of mean.
But But yeah, there is a lot going on in my industry, and on Friday I talked about some of the technical formations that we're setting up, and a true technician doesn't act until those formations are completed. So that's the caveat. But we are set up for what we would call a monthly risk reversal in the large cap banks. So it bears watching. Now this week is a very thin traded week. The big banks have huge buyback programs, so anything can happen. But what I wanted to emphasize within that caveat, the caveat that I think the bank stocks are going to be sold.
Okay.
The question is, where do you want to position if they are going to be sold? And I think you want to be selling the large cap money center / investment banks. And there are a couple reasons for that, and then I'll get into some individual names. But on a high level, the first is starting October 10th, we saw some bloodletting in crypto assets. And since then, some of these crypto exchanges have been hurt. They've removed liquidity, and that bloodletting has continued to this day. And the question is, do the margin calls that are occurring there ripple out to create a bigger problem in capital markets? And my answer is, I think they will. And so therefore, we're going to have a dislocated capital markets environment going into year end. And so the question is, how do you play that? And my way of playing that is either selling or avoiding the big trading banks and buying regional banks. Now, there's another theme sort of tucked into that that's going to play out over the next 12 months. And that theme is that Trump and his administration has to move towards policies that favor Main Street over Wall Street.
Okay.
He suffered significant, defeats in the recent elections. He can't afford to lose Congress next fall. Honestly, to bring it down to a crude level, if he loses Congress next fall, he's going to face impeachment hearings, and I think he knows that.
Yeah.
So he needs to pursue populist policies. And I think that meeting with Mamdani was just an incredible indication of his acknowledgement that populist policies are what he needs to pursue. So a lot of the things like, fighting China, tariffs, they go by the wayside, and things like trying to improve the American dream through home affordability start to emerge. But the bottom line of all that is, if he starts to emphasize Main Street over Wall Street, then your revenue driver is going to be net interest income, which is a big driver of regional bank revenues. And what will take a back seat will be Wall Street, which is capital markets revenue. So there are a lot of subtle things in those comments as to why I'm favoring regional banks. I will just at the top of the show say, I personally am buying, M&T Bank, or I should say I own and favor M&T Bank and then US Bank. Those are the two regional banks that I favor.
Okay.
So let's talk about near-term trading, because all these big banks are up strongly this morning. The one that I'm watching is Morgan Stanley. It got an upgrade this morning from Wolfe Research. That analyst is well respected, carries a lot of weight. So it'll be interesting to see. I mean, you knew it was going to open strong this morning on that upgrade. The question is, what's it do at the end of the day? And that's going to be.
I'm going to share my screen for some of your presentations. Is that good? Yeah. Do you want me to do that?
Let's start with the Morgan Stanley.
Oh, wait, sorry about that. I had to tell you that Stanford won the big game. Oh, the weenies were weenies.
I didn't even know that Stanford had a football team.
It mattered. You know what? Neither did they. So, but they still won. They won against Cal, so it's called the big game for those of us out here in the West Coast who went to one of those schools. Anyhow, all right, Morgan Stanley.
For all those Tom Brady haters, the Patriots now have the best record in football.
All right.
Anyway, so Morgan Stanley got upgraded this morning, and the upgrade was based on the strength of their wealth management operations, which have done phenomenally well. I mean, they between Gorman and Ted Pick, they've done a great job of building out that operation. It's the main reason that they trade at 3+ times tangible book and at 15 times earnings. Morgan Stanley is literally the most expensive bank stock that I follow. And, it's part justified by the stability of Morgan Stanley's wealth management operation, the high returns and pre-tax margins that it generates. And that's what contributes to Morgan Stanley's ability to generate a 20% plus ROTCE. But what I wanted to talk about, so on the top chart is the wealth management revenues for the major banks that I follow that have large wealth management operations. And Morgan Stanley is growing the strongest. This year, in 2025, there's talk about there's expectations of a low double-digit growth in wealth management revenues, and there's a similar expectation in 2026. So there's a tremendous amount of what I would call positive sentiment around that operation going into 2026. On the third quarter earnings conference call, the CFO of Morgan Stanley talked about how NII in the fourth quarter will be up, versus the third quarter. So continued momentum, if you will. And she specifically mentioned the strength that they're seeing in SBLs. So SBLs are securities-based loans. Now these are different from margin loans, which are used to buy securities. Securities-based loans are loans where you use your securities portfolio as collateral, but you use the proceeds to go out and buy art, yachts, real estate. You may be paying, for business, expansion purposes, educations for your children, or some other purpose of going out and buying securities. And a lot of these SBLs were caught in the LA wildfire. Both JP Morgan and Citigroup noted that they had a big increase in the second quarter of this year in consumer non-performing loans related to SBLs. And these SBLs were related to loans that these high net worth individuals took out, in California. So the point is that we've seen these SBLs grow very, very rapidly.
Yeah.
And Morgan Stanley is the largest player with over a 20% market share in this category.
And why is that? Is that just because they have looser? Why did management decide to go heavily into that? Is it because their clients demand it, or why do you think they're the leader?
They want to own a lot of art in the next downturn. They want to own a lot of art.
Yeah, it was a strategic decision to push that product. Because they deal with a lot of high net worth individuals. It is a very cheap source of financing, and they view it as low risk because the LTVs are usually less than 60% on that portfolio. But the point is that they are subject to margin calls. And if what we're seeing happens in the crypto space, where there's clearly margin calls, spill over to other areas because of market volatility or declines, it clearly has to require declines, then these SBLs become a risk.
Yeah.
And that's important because if you can't grow that portfolio, then the NII, the net interest income that's driving a lot of the wealth management revenues, becomes at risk.
Okay.
And that's one of the things that people are paying up for. So to me, it's worth watching what happens to SBLs if we get a market, correction of severity. Because Morgan Stanley is priced for perfection and doesn't have room for discipline. So let's move on from there. And if you can put up the next slide. All of these commentaries are around my belief that the capital markets are at risk of a dislocated event. So here's Wells Fargo's net interest income. And I give you total net interest income on the top line. Then I give you the markets related net interest income. And then the third line item is the core bank's net interest income. The core bank being basic blocking and tackle lending. I take in a deposit and I make a credit card loan. It's the markets related NII that I want to focus on. So in June of this year, Wells Fargo's asset cap was removed. And that gave them ability to start to expand their balance sheet. And they made it a strategic priority to really make a push into becoming one of the big boys on the trading front and in the investment banking front. And so they expanded their balance sheet very rapidly in the capital markets areas on the balance sheet. And that's the bottom line, as you can see, trading assets in the bottom line.
Yeah.
The
And
point
whose assets are these? This is their own assets that they're trading.
Yeah, their inventories.
Okay.
So
Are they doing this to get for individuals to kind of entice them or companies to do business with them, or why are they doing
it's
this?
mostly institutions. They
Okay.
want to break into the big leagues, which means
Okay.
you're a counterparty to
Got
the
to show that you got to be counterparty. Okay.
So on the fixed income side, it can be corporates, but on the prime brokerage side, it's probably hedge funds, macro funds, etc. And so you're seeing, what is it, 32% year over year increase in the third quarter in their trading assets.
Okay.
That resulted in a double-digit increase in net interest income in trading related NII. Whereas the core bank, where the basic blocking and tackling, the NII is only growing 1% a year. So if we have a dislocated, and these are ifs, but if we have a dislocated market and they're forced to deleverage, then there's going to be a disappointment in their NII outlook. As far as 26 forecasts go, right now the total NII is projected to grow about 3% plus or minus, but much of that is coming from, at least in my mind, when I think through what people are saying, is coming through market-related NII. So if we have any deleveraging event, we're going to see a disappointment on that total NII. So something, again, worth watching, because I think Wells Fargo shares are vulnerable here. And let's go to the last one, and then I'll shut up.
No, never.
So if there's one company,
never.
Never.
If there's one company that epitomizes the financing of this asset bubble, if that's what you want to call it, it's Goldman Sachs.
I know, but my alma mater, don't you love the fact the CEO is a DJ? Come on, Charlie. Don't they get like a DJ premium?
But no, because he doesn't play as good a music as you do, Nadine.
Okay. All right. So no DJ premium with that multiple. Okay.
Yeah, we miss your music in the morning.
Okay. Well, I was gonna give one today, but we couldn't figure out how to do that on Riverside. But next time.
All right.
Yeah.
So these two charts are a reflection of what Goldman Sachs is doing to finance revenue, to finance the asset, markets. The top chart shows NII, net interest income, or financing revenues by division. And so there are three divisions within Goldman Sachs. There's the global banking and markets, that's trading, investment banking. There's asset or wealth management, and then there's their platform or consumer, which is their credit card operation. Okay. And bottom line is that you can see that all of the growth is coming out of the global banking and markets, and that's them acting as a counterparty to finance hedge funds, macro funds, private equity, private credit.
Yeah.
So in a sense, the way you read that is the faster NII grows, the greater their counterparty risk exposure has become.
Okay.
The bottom chart shows the same sort of thing, but by product type, so fixed income and equity financing. And again, what you've seen is the prime brokerage business, which is equity financing, has grown very, very rapidly. So again, all I'm trying to say is we know these guys are very exposed to the capital markets. I will tell you right now, the bullishness around capital markets amongst my Wall Street, brethren analysts is very, very high. That's why you got somebody, raising their rating on Morgan Stanley.
Okay.
But I think the underlying vulnerability of this market is becoming more and more fragile. And I think we are moving towards a dislocated capital market. And these names, similar to what we had back in February to April, could drop by 30%. I don't know if anyone remembers that April drop into Liberation Day, but that was a 30% drop for these major bank stocks.
Okay.
So I'll leave it there.
So how do you want to play? You want to short these things now? You're looking for data before you short it? Doing puts? What are you doing?
Yeah, I am doing puts.
Okay.
I'm so short some of the names as well. The one that I'm really watching very closely is JP Morgan. That is the
Okay, JP
lead
Morgan. Okay.
here. They set the tone for everybody.
Yeah.
And what was interesting to me is JP Morgan traded off on Thursday, along with everybody else, and we had that
Yeah.
huge risk reversal trade in the broader market.
Yeah.
But it couldn't even muster up a bounce on Friday. And that was very telling that it couldn't muster up a bounce on Friday. And then this morning, it's flat in an up market again. So you've had 2 days, between Friday and today, you've had 2 days where the markets have bounced and JP Morgan can't bounce. That to me is,
Okay.
very negative, sentiment trading. And then, we're probably going to break the 50-day moving average here and then, test the 200-day moving average. That's only 2.5% away, the 200-day moving average. You
Yeah.
start breaking that, 2.5% is one bad day of trading. You start breaking that, then every technician is going to come out and start talking about how the banks have turned sour here. So there's some technical setups that I talked about on Friday. I wrote about over the weekend. I'll send that out to Wall Street Beach later this week on the platform.
Okay.
It's not,
What's
it's
the
not
time
looking.
frame on all of this? Like when, if people are thinking about this, or they should be shorting, MS for valuation, and sorry, changes in fundamentals here. Or do we need to be, watching some of these, the lending balances and all of this on,
Yeah,
do we need to
you want
watch
to
this
be.
now, or is it early?
It's not early. I mean,
Okay.
if something's going to happen, it's going to happen between now and December 9th. And the reason
Okay.
I'm December
Well,
9th,
that's very specific. What time, Charlie?
so
6:42?
What time on December 9th?
Yeah. Like what time and what's the weather?
9:30 a.m. So on December 9th, we have the second day of the Goldman Sachs banking conference.
Okay.
And it starts on the 8th and I think continues until the 10th. On the 9th, both Wells Fargo and JP Morgan give presentations. And
Okay.
typically in those presentations, they'll give you an update on fourth quarter trends. They don't always, but typically they do. If the update that they give you on the fourth quarter trends are for disappointing capital markets revenues, then the weakness that I'm anticipating is going to continue to play out. And then on December 10th, we obviously have the Fed meeting.
Yeah.
And with the toss up now as to whether they,
And what do you think on that? Do you think like they're gonna have to cut no matter what, or you think they could pause?
So I'm taking the other side of Ben's bet,
Okay.
and I'm saying that they're going to pause, which is
Okay.
where I've been now.
Well, the market's gonna go down if that happens.
Exactly. Now, listen, I've learned to respect markets, and right now the markets are telling you that the chances of a cut have risen from 30% a week or so ago to over 60% today, and that was all based on Williams' comments on Friday, where he threw his hat into the ring of a possible cut. But
Yeah.
here's how I break down the FOMC. If we have time, cut me off if we don't. But,
I always got time for you, especially when you make such specific recommendations.
there are 12 voting members, as you know. We've got
Yep.
very clear 3 doves and very clear 3 hawks. The doves are Moran, the Trump appointee, Bowman and Waller, who are chief candidates. So they're going to keep talking about cuts. You got 3 very clear hawks. Barr, who just gave a speech recently, about the need to be careful, watch inflation. Schmidt, who is an inflation hawk, and Collins, who has spoken about remaining an inflation hawk, but sometimes softens her tone. So you got 3 doves, 3 hawks. In the middle, you got 5 could be. I will say that both Powell and Jefferson have remained centrist. They have not shown their hand. So then you look at some of the others. Cook, who is under pressure from Trump, has recently talked about possibly easing.
Yeah.
Goolsbee, who's the Fed president out of Chicago, has talked about pause. Musalem, who is the St. Louis president, has talked about pause. And then Williams, who gave that very important speech on Friday, has talked about hawk. So all of a sudden you move two from centrist to the dove position and two to the hawk position. So you still now have 5 hawks, 5 doves, and you got Powell and Jefferson in the middle. So at the end of the day, it's going to come down to what does Powell say. And
Yeah.
I think his idol is Paul Volcker. And I think he wants to go out as an inflation fighter. And so I think that's why we get a pause.
And then is he like fired immediately, or what happens?
Well, he can't be fired.
I'm just kidding, Charlie.
But those are the pressures. I mean, that's why Waller and Bowman are voting for a cut.
Yeah. All right, well, we'll leave you on that depressing note of I'm kidding. No, so we don't know what's going to happen, and so I guess if you go long.
By the way, that would be really all of that would be very. Yeah, all of that would be very negative for the XBI, which has been counting on another cut. So.
Yeah, I think it's really going to come down to what data do we get between now. Yeah.
All right. Well, listen, that's it for us today, November 24th, 2025, just a few days away from Turkey Day. Charles Peabody, David Maris, Nadine Turman here for Wall Street Beats, powered by Passes. Thank you so much, and we'll talk to you guys soon.